Hello and welcome to IG's Trading the Markets podcast. And today I'm speaking with James Stanley, who's a strategist at Daily FX. He started working with equities back in 1999, options in 2000, and FX in 2009. So he's got plenty of nuggets of wisdom to share with us through his experience. So James, let's just start with the current markets. Clearly there was so much volatility in H1, and markets have appeared to have bounced back a lot more quickly than most were anticipating. What do you make of the moves?
There's, I don't think there's a lot that could be definitively made from what's been seen yet. I think that there's still a lot that has yet to play out. It does feel like we're in kind of that awkward stage of the process. It's kind of like when I think you're in like middle school when you're at a dance and the boys are on one side, the girls are on the other, and it's just kind of that awkward silence. We're waiting for that, that initiator. So without a doubt, there has been a huge sucker punch to global growth, and there's also been a very strong response to that sucker punch so far, particularly out of the U.S. I mean, we've seen trillions of dollars of stimulus laid in already. These situations are unprecedented. I mean, the last global pandemic of an even similar scale is like 100 years ago. And markets 100 years ago are far different than markets today. The way that macro has really taken over the world as we've all become more interconnected to the internet. So there's really a lot of unique elements here. But when I take a step back from a market perspective, there are a lot of similarities to 1999, where we knew the valuations were outlandish. We knew the prices were running too high. We knew that there was kind of a bubble that was getting the best of itself. But from a trader's perspective, there's not really a lot of great options. It's either chase a move that's already well developed that may turn at any point, or you're trying to fade one of the strongest trends we've ever seen. I did the math yesterday. I think the Nasdaq's up like 50, or it has been up as much as 52% off the March lows. 52% in 3 months, and we're back at all-time highs. So, I mean, if we go back to February and we look at the justification for those valuations, it's a completely different picture today. Now, there's a lot of reasons as to why that's happened, particularly the stimulus front. We've seen the Fed jump in, the Treasury Department's jumped in. It looks like Congress is going to pass yet another stimulus package that looks like it might be over $1 trillion. At least that's kind of the scuttlebutt at this point. So this big sucker punch to global growth, it's been met with a strong monetary and fiscal response. But I don't think that we've seen the worst of this yet. That's my biggest fear, is that there's a lot of hope that we have seen the trough on the data. I don't necessarily know that that's the case. I think there's going to be a knock-on effect, particularly with real estate. It's going to cause some shockwaves in the second half, and maybe even as deep as 2021, 2022. These things don't just go away on their own.
Absolutely. I mean, you were sort of referencing the fact that there are similarities between the dot-com bubble. Are you suggesting that prices today are looking sort of bubble-like?
So calling a bubble is always hard. I mean, technically, we can't call it a bubble until it's popped. Otherwise, we don't know that it's in fact a bubble. So it's kind of like one of those paradoxes where we really have to wait for it to pop before we can say, yeah, that was a bubble. But there are some very, very close similarities. I started trading in 1999. There was a bubble at the time. A lot of people were talking about it. I didn't believe it. I was a noob. I didn't know what was going on. I just knew that stock prices had a tendency to go up. So if you're sitting on the long side, by and large, you kind of have the forces of trend behind your back. And it seems like something similar is going on today. I know that there's a lot of talk on the internet about the quote unquote Robinhood traders. And it's tough for me to see those because it harkens back to what I was going through 20 years ago. But it does seem as though there is one of those themes going on right now, where gains in stocks are just super cheap compared to what they traditionally would be. And there's a lot of retail money that's in the market that is chasing stocks when they're near all-time highs. And I mean, we're in the midst of a global pandemic, and we now have social unrest unseating pretty much every big city in the United States. I would argue that right now.
Sorry to interrupt you, but I just want to ask you, I mean, do you think that the fundamentals matter anymore? Because like you were saying, it seems as though the markets are driven more by the stimulus that we're seeing from central banks around the world. I mean, that's likely to lead to huge levels of debt down the line. Do the fundamentals not matter? Yeah. And does that debt later on not matter as well?
It's a great question. And, again, we can go back to 2009, 1999, and in both cases, that was a very requisite question, whether or not the fundamentals matter. And I think traditionally, if we go back, like, say, over the last 120 years, the importance of fundamentals like prices themselves, like markets themselves, are cyclical in nature. When we're in one of these good times, valuations have a tendency to rise. Folks are willing to chase. They're willing to pay a little bit more for that extra dollar of earnings. And then when we're in a trough, or when we're in, I don't want to call it a recessionary backdrop because that seems so foreign to where we're at right now, considering everything that's happened. But when we're in one of those recessionary types of backdrops, then that's traditionally when valuations would tighten up a little bit lower than the long-term average. And then eventually they'll perk back up. So I think it's a cyclical type of thing. And at this point, I do think there's a bit of distortion just from overall policy. I mean, if we go back to just 2009, the idea of the Federal Reserve jumping with QE was out there. I mean, I remember on television I think this was '08, in the middle of the collapse. Hank Paulson gets on TV. He's crying. Man has tears in his eyes. This is a guy that used to run Goldman Sachs. He has tears in his eyes because he has to nationalize American companies. And I remember him saying, I never thought I would have to do this. But here he is crying on television, nationalizing public companies. At the time, bailouts for publicly traded but private corporations was thought of as being outlandish. Now it's commonplace. We get a sucker punch to global growth, and then the immediate response is, okay, yeah, let's just do this thing that's worked for the last 10 years. We don't know that this one sample of what's happened over the last decade or since 2008, 2009, we don't know that this is a sustainable model moving forward. It's just become the evolution of neo-Keynesian economics, which is pretty dangerous because neo-Keynesian economics, by definition, needs an element of balance, where when you are in good times, you run surpluses, you pay down debt, you get the ledgers back to even, so that when you're in tough times, you can extend that debt. You could take on you could absorb a little bit more risk. And then it balances the scales. We haven't had that scale balancing. For the entire decade after the financial collapse, we basically had loose monetary policy the world around. And with some hindsight now, it's very apparent as to why the Fed had such a defined hiking bias, right? Because, at the time, I know there was a lot of scuttlebutt, they just want to raise in case they need to cut again. Well, no, they wanted to get off of this lower bound so that they could actually get back to the other side of the cycle. They were willing to maybe take a hit to growth, a hit to inflation, just in the effort of making things quote unquote normal.
So you mentioned the fact that markets are cyclical in your answer, but to me, it doesn't feel very cyclical right now because obviously we've had a long period of extended fresh all-time highs over recent years. Then we had this massive collapse in the first half, and then we had this kind of like V-shaped bottom. We've bounced back right up to the top. Do you think that we're heading back down and there is more of the bear period of the cycle to come? Or was that shortest bear market in history, is that now over?
I don't think so. I mean, my anticipation is that the next 6 months are where we're going to see what this really is. My big fear right now is real estate, especially in the US, because when we went into shutdown, and this is residential and commercial, when we went into shutdown, there was a lot of protocols put into place so the people that were impacted by the coronavirus weren't going to get kicked out of their homes. They weren't going to get foreclosed on. And these are all good policies from a public policy perspective, right? But from an economics perspective, there's just a simple roadblock ahead that we have no clue. We have no idea what it's going to entail, right? I mean, there's reports out there of, major retailers, publicly traded companies that are not paying their rent, and they're openly flaunting that. Whoever holds that real estate, I mean, they're basically putting a crutch because now they got to pay the bank, but they're not receiving any income. So where's that domino going to fall? I think at this stage, we haven't really seen a lot of that play through yet because we have still been shut down. I know for folks in the States, there's been a lot of different, mortgage forbearance programs, right? Where somebody that has a mortgage but lost their job due to the coronavirus, they could not pay their mortgage for a few months and basically just tack on payments on the back end of the loan. Well, what's going to happen when those programs are done? And I think this kind of goes back to what Jerome Powell was touching on last Wednesday at the FOMC rate decision, which was, he kind of had a very stern about face where he said, we don't know what jobs are going to be there when these folks come back into the labor market. We simply don't know if somebody that was furloughed from a job is going to be able to go back to that same job. And I mean, if we think about it, just logically, he's right. A lot of those jobs aren't going to be there. I mean, imagine in New York, New Jersey, where I live, restaurants are a huge business. Going out, social life, I mean, it's a huge business. And really, restaurants are kind of the center of that, right? Well, when I was in college, I worked in restaurants for a little bit, and I learned there that it's not a good business to be in unless you actually love food. And the reason is because the margins are razor thin most of the time. You need a full house on Friday and Saturday night just so you can open up on Monday and Tuesday. But now social distancing protocols dictate that you can't be more than 50% full. those margins are going to come under massive amounts of pressure. Those restaurants are going to have a hard time paying their rent. And then the landowners or the owners of those facilities that are leasing them out, well, now they're going to come under pressure. There's a domino effect that could come into play in the not too distant future. I know for myself, again, in New York, New Jersey, I do not want to go out to a restaurant. But, the people that do, they're going to be constrained by these social distancing protocols. The owners of those restaurants are going to be under a massive amount of pressure. And it does lead to a very unsavory horizon unless something else comes into the equation that addresses that. I don't know what that something else could be, but it does feel right now like the prices are very divorced from reality. The stock market and the economy, they've been very divergent for a while, especially in the post-financial collapse backdrop when we did have global central banks with their foot on the pedal. But, this is an area that I think could potentially be inescapable, especially if there's a massive hit to real estate, both residential and commercial in the coming months because of the fallout or the flow-through effect of all these coronavirus shutdowns that we've had.
Yeah, so do you think it's basically going to be the continued fallout from the coronavirus that's going to be driving market prices in the second half of the year? Because there are quite a lot of other big events on the calendar as well, not least the US election.
Right. Yeah. I mean, I think it all kind of plays into it, through social mood via social media, and that's what, in trading, the most fatal phrase is this time is different. Kind of as a rule, whenever I hear that or when somebody says it, I kind of stop listening. I kind of qualify what they had just said because the reality is it's never really different. The nouns change, the verbs stay the same most of the time. There are some unique aspects of where we're at right now because, not only do we have the central bank theme, the stimulus theme, but there's kind of a new foundation under the surface with social media, with the way that people communicate with each other, with the way that ideas get disseminated throughout a populace that really does throw an asterisk on everything that we've seen in the past, where we have to ask, is it going to play out in a similar way in the future? Because now we have this brand new thing. And I think a good example of that, a really good illustration is what's taking place around these protests and social unrest. Even 4 years ago, 2016, much of the world was online. Social media was a big thing. That was the last time we had a big BLM movement. Well, now that we have the movement coming up, it's much more universal. People have almost accepted social media as a part of their lives much more than they did even 4 years ago, much less 10 years ago. And it's changing the world. It is literally changing the world in front of our very eyes. You see some of these statues that are coming down in some of these southern states, and these statues were there for hundreds of years. But it's just now that people have come together to say, hey, maybe we shouldn't have that. And I'm not taking a stance on this at all. I'm as apolitical as it gets. I live in New York and I basically just focus on markets. But, the fact that we're seeing these things happen in the way that they are, it's relevant from a historical perspective. Because for a long time, those statues have stood proudly in those town squares. Nobody did anything about them, even if they hated seeing them. And now we have groups of people that are coalescing on social media across social groups. It's not just one social group, across social groups to fix this issue as they see fit. It is that's a relatively new thing. And I think that impact plays through in markets as well. I don't know if it necessarily impacts market prices as aggressively as much of the media would consider. I don't think the Robinhood traders are what's driving this market. I don't. I think that they're along for the ride. But when you look at the cash flows that are coming into these asset classes, it's significant in nature. It's not just retail money. It's not just the Robinhood trader with $200 in his account. There's a dearth of other investment options. Yeah. And I mean, think about it. If you're a portfolio manager right now and you have $1 billion under management, you're sitting on 100 million cash. Well, is that really a good call right now? Because prices are going through the roof in equity markets. So when you send that statement to your customers and they're seeing that their ETF outperformed you, do they really have a justification for paying a management fee any longer? No, you got to put that capital to work. Well, where are you going to put it to work at? Buy bonds? All right. Maybe you'll get a little bit of run in the principal side of bonds, especially in the U.S., right? Fed just announced a corporate bond buying program. So about the best possible scenario there is getting long corporate bonds at really low rates already, historically speaking, and then just hope that those rates get squeezed and squeezed and squeezed. And then you can get like a little bit of a principal pop out of the bond, basically trading a corporate bond like a stock. Now, that might work for a little while, but eventually, as the Fed gets into that market, that could distort it as well, similar to what happened in treasuries. So bonds, not really a great option for that portfolio manager. Where are they going to look? There's not really many other options. And that's where stocks come into play. So it does kind of build into this self-fulfilling prophecy.
Yes, I wanted to just get a bit more of information about your trading style, because I know you're a combination of fundamentals and technicals. And given everything you've just said, would you say this is a good time to be trading?
I mean, I'm biased. I'll admit that right up front. This is just what I do. It's in my blood. It was what happened in 1999 that got me. And, as I tell friends, not like in a professional setting or whatever, but, when I tell friends about like my career and what I do, I describe it as being snake bit, basically what it was. I went to college in 1999. I always hated school. I think that for much of my youth, I had undiagnosed ADD. And so I just really hated school. I hated paying attention. You give me a book, I'll read it, I'll shred through it, I'll take the test and I'll do okay. But, as far as sitting in a class and listening to somebody drone on, basically just reading from a textbook, it just never really fit me. So it was fairly soon after I got to school in 1999, college, that is, where I kind of decided I needed something else to keep me engaged. I played baseball all through high school. And so I always kind of had that as kind of a balance point. When I got to college, I wasn't good enough in baseball to really do anything. And I realized that up front. So trading is what supplanted all of that. So I got into trading August 1999, right when I went to college. And I got in on the tail end of the tech bust, or tech boom, soon became the tech bust. And, the prospect of fast money, I was snake bit right there. And the very first semester of college, by my third semester of college, I was ready to drop out. I was ready to just go day trade for a living. Like, why should I do this? I hate school. Why am I going to pay all this money to went to a private school too? Why am I going to pay all this money to go to a school that I don't really enjoy going to when I could be making fast money over here? Luckily, I didn't do that because it was that semester that everything turned and the tech boom became the tech bust. And then that continued for pretty much the next year until we ran into 9/11. And then 9/11, there was another capitulation event. I'd already busted out by then, but I was snake bit from that quick period of fast money when I just went to college, enough to keep my head in the game. So at that point, I changed my major to business finance, and basically it's been doing the same thing ever since. Now, as far as whether or not this is a good time to get in the market, I personally try to kind of stay involved. There's certain times where I'll pull cash off the table. There was one of those times in the last 3 months where I did that. But, by and large, I think that, and this is the reason that I use technicals, I use fundamentals. Kind of my thought is if it's something that might be able to help me, I want to know about it, if not use it. It's nonsensical to me to ignore something that may be beneficial. So I try to incorporate as much as I can. And the benefit behind that is it does enable me to be maybe a little more fluid, a little more flexible based on the environment, based on the backdrop. But really, at the end of the day, it's all about adjustment and adaptation. If you want to get better as a trader, it's not about getting smarter, and it's not always about learning more. It goes right back to what Charles Darwin said. Those that survive in the species aren't the smartest or the strongest. It's those that are the most willing and able to adapt. And I think that's really important in trading and markets because we'll get these types of scenarios, right? Like we've already talked about two in the prior 20 years, 2009 and then 1999. You'll get these types of events. You'll get these types of times. And I think that when those come up, you have to be able to say, okay, the world's kind of going a little bit crazy right now. It happens. It'll correct at some point in one direction or the other. But now I have to get into a mode where I can adapt to that crazy. Either that or you pull everything off the table and you just wait, which to me is not really an attractive option because you'll never know when it's coming. You'll never know when volatility is about to growl. You have to be prepared for it so that when it does, you're already positioned in.
All right. And on that note, we'll have to leave it there. That's all we have time for today, sadly, on IG's Trading the Markets podcast. Thank you so much to my guest, James Stanley, who's a strategist at Daily FX. I'm Victoria Scholar, and don't forget to subscribe.
For more videos like these, subscribe to our YouTube channel, IG UK, and make sure to follow us on Twitter. We're at IGTV.